go over the last sets of modules, and we're going to be looking at deductions first. All of this again, at this point we've gotten all the income in. We've got all the various adjustments, things like the educator credit, alimony paid, things like that. Now we're at the next level to try and get down to taxable income. So again, we're going to understand how the tax liability is calculated, the different ways to lower the taxable income, because once you get the taxable income, that's where the math starts. The difference between the standard and the itemized, et cetera, et cetera. So again, tax dollars are not taxed on all of it. Okay, income is considered as taxable, must be reported on the 1040, but that doesn't mean that it's all being taxed. So the total income is not necessarily what is subject to tax. Total income minus adjustments is adjusted as gross income. That's what we did last week. Now we're taking it one step further, minusing the deductions, and that will get us to the taxable income, at which point they'll usually get, in our world, either a 10 or a 12% tax calculation. So again, taxable income is the sum of all of these wage, interest, dividends, cap gains, business income, pensions, taxable part of Social Security, employment, et cetera, et cetera. So total income, which actually is no longer going to be line 9, but it's the sum of all those other items. Now, we need to reduce total income to determine taxable. So there's a couple ways. There's the adjustments, which we did last week, IRA, student loan interest deduction, the self-employment tax, and then either the standard or the itemized deduction. And again, once you get to that first part of which is subject to tax, that can be reduced even further with the non-refundable credits, which we'll get to next. So again, deductions are subtracted from adjusted gross to result in taxable. There's two types. There's standard and itemized. You can only do one. Software takes the better of the two. Again, adjusted gross, tax-wise, we'll choose whichever the highest, standard or the itemized. Again, the standard deduction, again, that varies every year based on an adjustment for inflation. Additional standard deduction, you get higher if you're over 65. Again, you can only take one or the other. Again, some people have to itemize if they're filing married separately, and one itemizes and the other one has to. Again, generally, our folks that are married filing separate, neither one itemizes, so we don't really see that hardly ever. These are the standard deductions for, actually, I should say 2025, but these are the amounts. Single, it's 15,750, 31,500 for married filing joint, and 23,625 for head of household. So if you're 65 and older and or blind, you get $1,600 for each taxpayer, $2,000 for head of household. And an individual who qualifies as dependent, again, you got to be careful what their income is. Sometimes we have situations where, again, they particularly have investment income that could jeopardize that a little bit. Now, itemized deductions, again, this is an important part of the first one. Under the current law, most VITA clients have lower federal taxable income using the standard deduction. Generally, the only people that we itemized for last year are ourselves, so the VITA volunteers, or friends of theirs, or every now and then we will have a few higher earning singles who do have a mortgage and real estate taxes, and maybe they're particularly charitable. It's very, very rare. Okay. Like it says here, taxpayers with higher incomes or high mortgage interests are more likely to benefit from federal itemized deductions. But the nature of our cohort is tend to be lower. But again, if someone's bumping up into like the 70, $80,000 range, and we like to do their return, they could easily itemize. Again, we're focusing on the federal returns. There's not a lot of itemizing that goes on for the state of New Jersey with one item in particular, and that's the first one, is medical and dental expenses. The other itemized items, expenses are uh, the SALT taxes, state and local, and income taxes and real estate taxes, home mortgage interest and points, gifts to charity, and certain other miscellaneous deductions. The most common is the gambling losses, uh, reference to their gambling winnings. And again, if they get a higher standard deduction, I mean, they will pick whichever one's the highest is what they're gonna, which one we're gonna go. A lot of people, again, if they won $30,000 gambling, but they lost $30,000, they're gonna itemize. Okay, though that's kind of like the paradox in a way. But again, this year, the new law is only 80% of your winnings can, or 80% of your winnings can be offset by losses. So in that case, maybe that's not going to work like it used to. Now, so medical, um, uh, again, 7.5% of AGI will flow through as an expense for to qualify to itemize. It's only 2% for New Jersey. And that's important to remember when you're going through the interview process with clients. Generally, anybody who has any kind of medical expenses is probably going to get a little bit of relief for the state of New Jersey, almost never for the federal. Okay, and all the medical expenses include doctors and dentists, prescriptions, hospital insurance premiums, um, mental health treatments, the actual mileage and tolls if you're driving to Philadelphia to Penn Medical. And there's some other ones, and there was, but those are the big ones, co-pays, um, prescriptions, hospital bills, etc. Okay, taxes, there's this state sales tax or the income tax. Usually the income tax is always the one we go with. Again, if there's any local or foreign taxes paid, real estate taxes, personal property tax. Um, Again, that since 2018 it was limited to $10,000. Now it's up to 40. Um, Again, given where we live, and a lot of our folks live in Hamilton, Trenton, parts of Ewing. People don't have property taxes or $10,000. A number of our seniors who, again, they live in Hamilton, they've lived there forever, homes paid for 20, 30 years, their taxes are, $7,000. So again, there's nowhere near a chance to any kind of itemize anything. Other interest itemized expenses that you can take on, the home mortgage interest, private mortgage insurances we can add those back in now. Again, cash or non-cash donations to charitable organizations. We do see a lot of people, church-going people who tithe and they give quite generously. Unfortunately, it doesn't really help them, at least in this life, maybe in the afterlife for doing the right thing. Again, miscellaneous deductions, gambling losses up to the amount of winnings. Again, for those of us old enough to remember that prior to 2018, there were other miscellaneous deductions, things like union dues, unreimbursed employee expenses, et cetera, et cetera. All that stuff is gone. Work-related expenses are allowed for a disabled person. We've had that once, I think. Again, casualty and loss, theft losses, that's way out of scope for us. So again, taxable income is not total income. Total income minus the adjustments is adjusted gross. Adjusted gross minus deductions is taxable. There's one or the other. And again, the sum of all of those, and you're gonna know right away. Again, when someone comes in and they're single and they've got almost the standard deduction is almost 16,000, and they say, "Yeah, I own my own home." And my property taxes were $4,000 last year, but I've got great health care. I am retiree from the state. I don't have I had a couple of co-pays. That's it. You know right away that they're gonna be getting the standard deduction. We don't have to like struggle to try and get to that number because you're either gonna be there or you're gonna be a mile away. It's usually not even close. All right, so that's it for, again, deductions. Okay. So now let's move on to non-refundable credits. Now, non-refundable credits are, here we go. Um, all right, non-refundable credits are another way to reduce the actual tax liability after it's been calculated. There's four main ones that we focus on: the child tax credit, the credit for other dependents, the credit for child and dependent care expenses, and the retirement savers credit. So again, it's a dollar for dollar reduction for the tax liability. A non-refundable credit can only reduce the tax liability to zero. Again, taxpayers with no income tax will not benefit from claiming the non-refundable credits. We see a lot of that. Okay. A lot of people just can't take advantage because their income's not high enough to generate enough tax that some of these non-refundable credits would erase anyway. Um, yeah. Okay, so here's an example. Chris had a federal income tax due. So after, again, his taxable income is calculated, his tax due is $470. He meets the eligibility requirements to claim a $500 credit for other dependents and a $100 savings credit. The total amount of those is $600, which is higher than his income tax of 470. So again, all that goes to zero, but the missing 130, the other $130 is just goes away. It never happened. Um, and again, we do see that quite often. And again, as you're going down the 1040, you'll see how that chips away and it gets to total tax is zero. So the child tax credit, again, this is the first part of the child tax credit, is non-refundable. It's $2,200 per child, qualifying child. Um, Okay, taxpayers who cannot use the maximum non-refundable credit may be able to get the additional child tax credit, which is in the next module, and that's a refundable credit. Okay, you'll have to fill out Form 8812, and we'll go through that. Actually, we'll do one tonight to see how that works. But again, usually people who are having one or two children don't use all of the refundable, non-refundable part of the credit. So these are the considerations to qualify. The child must be under 17, which means if they turn 17 in 2025, they're no longer eligible. They must be a U.S. citizen, they meet the relationship test, they're claimed as a dependent, did not provide more than half their own support, which is generally pretty straightforward because they're children, and they lived with the taxpayer for more than 6 months of the year and have a valid Social Security number. Again, must be any one of these. We did this when we were talking about claiming dependents. They got to be one of these: son, daughter, adopted child, stepchild, foster child, brother, sister, half brother, or a descendant of any of the above, like a grandchild. This is something I kept in. I mean, it's a few years old, but those of you to remember, coming out of COVID, they had quite a generous um, uh, child tax credit was basically what really made this quite impactful was there was no earned income requirements. That's key. So if someone who had a qualifying child in 2021, they were getting at least $3,000 even if they didn't earn a dime, which a lot of people weren't because they weren't working. Um, Again, that all went away, by 2022, and it's still that way now. Okay, credit for other dependents. Credit, again, this is non-refundable. The maximum is $500 per qualifying child. Could be a qualifying child or a qualifying relative, which actually would qualify, again, if you have like a teenage son or daughter, now they're out of the child tax credit age, but now they're old enough for the other credit for other dependents. Again, they must have a social or an ITIN. An ITIN will work for that. And they must be a U.S. citizen, U.S. national, or a resident of the U.S. So here's one. So here's Francine. She's 43. She earned $43,000 in 2025. She supports her widowed mother-in-law, Connie, whose only income is Social Security. She's got two sons, Henry, who's 16, Neil is 12, and her mother all lived with her in Chicago all year. Her sons did not provide any of their own support. Everyone has a Social Security number except Francine and Henry, who have ITINs. So who could she claim for other dependents? Okay. Again, the first two, again, because they're of their age and or relationship. Connie is a qualifying relative. Henry is a qualifying child, uh, even though he's 16. Okay, now yeah. Okay, so Neil, he's only 12 and has an essence. He is Francine's qualifying child for the child tax credit. So you get one or the other, and it will show on the tax return when they age out which one they qualify for, which is kind of handy for tax. And that's also a good check to make sure that you got the birth dates correct or birth year correct anyway. So we don't see this very often, the credit for child independent care expenses. This is a non-refundable credit that allows taxpayers to reduce the income tax by a percentage of their total child independent care expenses. And you can base that off of $3,000 per child, per qualifying um, child. Um, they must be under 13. Um, Again, they can only claim it because there's not a spouse to be able to provide self-care. A dependent is unable to provide self-care. You use Form 2441 to do that. You need what you need there though is the you do need to have the EIN from whoever the daycare center is. We get a couple of these every year. People that go to the Boys and Girls Club or one of the other like Catholic Charities has an after-school program. Um, but again, a lot of our folks don't have that kind of spare cash to send their kids to after school care, so they're staying with a friend or relative, and maybe there's a financial arrangement in there somehow, but that's not going to qualify them for the credit. So again, there are 5 tests to determine the taxpayer eligibility to claim the credit. It's again, they must be a qualifying person, their earned income, they have a certain earned income. It's a fairly high bar, so our folks are generally going to at least meet that test. Again, the care must be able so the taxpayer can work or look for work, not because maybe they're going to the gym or something. Um, and if they are married taxpayers, they have to file a joint return, so it's not available if they file married separate. And you must provide um, uh, the employer ID number at name and address of the facility. So Chantel is single. She works full-time as a data entry clerk. She's got 2 children, Alex and Ashley. Alex is 3 years old, attends daycare while she works. Ashley is 7, stays in after school care until she finishes working. For the tax year, she paid $7,200 to Bright Beginnings Daycare for Alex's care and $1,800 to Smith Jones Elementary for Ashley to attend after school care. What is the amount of credit that she can claim? Again, she can claim the full 6,000, even though 1,800 was only to the one. You can kind of like just add them all up and split them among two. So the retirement savings credit, we see this very we see this more often than you would think sometimes. Um, this is the savers credit. It's generally done as a payroll deduction. A lot of times, uh, taxpayers don't even know that they have that they're doing it. Um, Again, once that's indicated on the W-2, a form 8880 will pop up within the software, and you have to fill in a few lines to make sure that they get it. Again, they must be over 18, not a full-time student, not claimed on someone else's tax return. So we're talking more like a working adult now, okay? And below certain AGI limits, which is generally well within what we see. Uh, I'm not sure exactly if the graph here at the bottom is updated. I didn't get to this one, but you kind of see you don't get a full credit for how much you contribute. But again, it's a percentage based on what you contribute and against your income range. So again, it could be in a traditional IRA, a 401k, and you'll usually see it in box uh, 12D. And it'll be a code C is generally an employer plan. That will automatically pop up the 8880 for you to fill out. So again, in this example, a single filer has $20,000 of AGI. There's a $1,000 contribution. He gets because of his income and that number of that $1,000, he gets to take a credit of $500. So his tax burden would be reduced by $500. Again, $21,000, a 2,500 contribution. He gets to do 20% of the $2,000. This is 400 because that's the maximum. Every now and then you bump into a few people who do get the maximum. Generally older people who are still working and don't really aren't really using it to sort of fund their lifestyle, if you will. They just keep socking it away. Okay, so now my favorite one is refundable credits. All right, this is the one that really kind of can juice a tax return for folks. Um, Again, how we're going to be looking at the three main ones here: um, the earned income credit and the additional child tax credit. The premium tax credit is for the Affordable Care Act stuff, which obviously we've all seen a lot in the news about that. That generally doesn't. I mean, it has a usually a negative impact on a taxpayer's return, whereas the other two have a positive impact. Again, a refundable tax credit is considered a payment made by the taxpayer. Refundable tax credits can reduce the tax liability to zero, pay for other taxes like self-employment taxes, and any amounts greater than that are paid as part of the refund. Taxpayers with no income tax who are eligible for refundable tax credit should file a return even if they are not required to file. And we'll get the only way where that really works is the refundable part of the American Opportunity Credit, and we'll get to that in the last module. So here's an example. Jeremy has federal tax income tax of $2,600. He can claim the $2,200 non-refundable child tax credit and the $1,700 refundable earned income tax credit. The total amount qualify of 39 is higher than his income tax. He gets the difference, reduces the tax, and he gets the balance as a refund. Now, these are mostly all these examples too are assuming that that after the tax there was no federal withholding. A lot of people, which juices their higher, bigger refunds, even though they probably know they're not going to have any tax liability, they have tax taken out. So now you've got a zero tax liability. You've got the refundable child tax credit. You got the earned income tax credit plus whatever they had withheld, which can really be a substantial refund. So taxpayers who cannot use the maximum non-refundable child tax credit may also be able to claim the additional child tax credit. That part is the second one there, which is $1,700 per qualifying child. Again, it's the same qualifications as originally in the non-refundable part. Again, most important to claim the additional child tax credit, taxpayers must have more than $2,500 in earned income or have three or more qualifying children. This last part here is not correct. It's in the 4012 and it keeps popping up every now and then. And we've had clients come in and say, actually reference this somehow. And I've been back and forth with the IRS on this, and that, for whatever reason, is still in the language. But again, if you have three or more children and you don't work, you're not getting any earned income credit. Again, once the child is claimed and you can qualify for the earned income credit, I mean for the additional child tax credit, you'll be requested to fill out an 8812, and we'll get into that shortly. So the earned income tax credit, again, this has been around. Again, this is a tax benefit that can serve as a financial supplement for taxpayers with low to moderate income, particularly those with children. Believe it or not, this goes back to, I think, pre Eisenhower, as being usually has bipartisan support of, again, these are people, they are work. Remember, it's earned income. So you have to earn something to get the credit. It's not like they're not earning it. And again, the whole idea is it helps adjust that family income to a level of reality that they can support themselves. Again, once you're claiming EIC, you need to fill out the schedule, and we'll go through all that. It collects a lot of different information. There's a lot of due diligence involved with EITC. Okay, the maximum credit for 2024, I'm sorry, it's actually 2025 tax year. I didn't overwrite that, but it is a little over 8,000 with three or more children, 7152 with two, 4328 with one, and 649 with no children. How do you qualify? Okay, you have to have earned income, be a U.S. citizen, have a valid social security number. Investment income is less than 12 grand, which is always not an issue with our folks. You can't file married filing separate. There can't be no foreign income. And for earlier years, the the individual must be at least 25, but less than 65. Actually, that's what it is now. During COVID, that kind of went away because a lot of people were in a situation, and they sort of opened up the age qualifications, if you will. They can't be a dependent of another person, can't be a qualifying child of another person, and must have lived in the U.S. more than half the year. That part about a 65 is very distressing in certain cases where um, a grandmother has custodial custody of grandchildren, and she's working to support them, and she may be right in the sweet spot for earned income credit, yet but because she's over 65, there's nothing there. It's pretty sad actually having when they're 64, suddenly, they get like a four or five, $6,000 check. She turns a year older, nothing. It's that black and white. Okay, actually, this is for 2025 as well. This is the adjusted gross levels. Um, Again, you can see like for again, as I've said many times, we have, oops, there we go. For a single person, again, if you're up to $19,000, you're not going to get the EITC. So a fair amount of our working people are north of that. So they're not going to get, again, it's only, $600 or $700. But again, a lot of our singles don't qualify. And they're over 65 too. So the qualifying child rules is the same situation as the child tax credit. There's no real change in any of that. The important thing to remember with dependents and the filers for EITC, everybody's got to have a social security number. So if mom and dad have ITINs and their kids were born in the US and they have socials, they're not going to get the earned income credit. Again, what qualifies as earned income? Earned income is income you receive from work. Uh, Income that is generated from interest, rental income, investment income, pensions, workman's compensation, unemployment, that's not earned. Again, that kind of gets back to what we talked about when in just talking about income. So here's a situation. David and Daniela, they're married, they wish to file a joint return. Um, They earned 58,000 in combined wages, and they sold $8,500 worth of telephone company stock they inherited from David's mother to help purchase a large vehicle. And they have 8-year-old triplets. Are they eligible to receive the earned income credit? And this is one where if you actually have a situation like that and you see like why they didn't, and you have to kind of step back because there's a two-part process. Again, we usually don't see this because this when it happens that bumps up at the higher end. So they're not eligible. So although the investment income by itself, they're below 85, the 11,000, and the income itself is not a problem. The problem is, okay, there's earned income and there's adjusted gross. So that $8,500 gets added to the 58, and so now their adjusted gross is above the limit. Both numbers have to be below. So if they sold $1,000 worth of company stock, they would have been fine. Okay, a couple thousand. But obviously they're through the higher end now because of that. Again, we don't really see this off and on. It has happened once or twice that I recall over the last few years, and that takes a little head scratching. You're just kind of like, oh yeah, that's why. Um, I mean, the software will do it correctly, but sometimes you got to wonder, like, what did I do something wrong? Because clearly their earned income is within the band, but not their AGI. So this is a very handy chart to kind of get your head around who qualifies for the earned income credit, how it works, and what happens when people say like I got a lot more last year than I did this year. And what are the reasons why? Well, as you can see, like in the middle there, this is an old chart, so it's not quite skewed to the new levels, but the principle is identical. The more you make, the less you get. The less you make, the less you get. So there's that sweet spot there in the middle that you're going to get that maximum EITC amount. And the more, again, as people do better, and we've had people, it's like, I mean, I got $2,000 more of a refund last year than this year. Well, you made $6,000 more. That's why, and that's where it's handy to have our 3-year comparison and tax wise. It's a great, quick way to address their concerns. It's like, would you rather have the 2,000 at one time in April or the 6,000 throughout the whole year? Easy for us to say because they're looking for that $2,000 check that they've been used to, and now that they're not going to get it. But they are doing better. That's kind of the whole point. And when it goes the other way, maybe they didn't work, they got laid off, they got sick, whatever, and there's just not a lot there. Again, the idea is the courage was at least a certain level to get that maximum EITC. The premium tax credit, I'm not going to spend, I'm going to go through all this. Um, this is a refundable part that taxpayers may get to help them pay for health insurance through the Affordable Care Act. Yeah, actually, I'm not going to spend a whole lot of time on this because the issue here is when you sign up, like right now during open enrollment through the marketplace for healthcare in 2026, you have to indicate what you think your income is going to be for 2026 based on where you live, et cetera, and the size of the household. The software will calculate the what your part of that is going to be, what you're going to have to pay. A year from now, you're going to have to reconcile all that. And if you hit it right, there's no real adjustment. Let's say uh, you underestimated your income. Okay, that's what most people do. Now you've gotten more of a credit than you were entitled to. Now you got to pay it back, and that's what most people do. Very rarely do people get refunds of the premium tax credit. Again, the taxpayer's income has to be between 100 and 400% of the federal poverty guidelines um, for this region and tax family size. Now, if you go over by like $1, if you're at 401% of the federal poverty line, you got to pay every nickel back that you got as far as a credit for whatever health insurance you paid. That's the bad news. And we see a fair amount of that. Let's say somebody during the year they got a new job and they're making a lot more money. Well, that's great, but they didn't tell the exchange. Now they've been underpaying their premium, and unfortunately, that has to get paid back, and it can be substantial. Again, if they have a fair amount of withholding, or if they qualify for some other the earned income credit or the child tax credit, some of that can help mitigate this. But a lot of times it doesn't, and it wipes out whatever small refund they might have, and now they owe. So I'm not going to spend, we'll go over this when we do an example because the PTC stuff is on the advanced test. Uh, One thing about the PTC is clients must bring in the 1095A to show that they had um, health insurance that provided by that particular insurance company. Um, and it won't get filed if they don't. I mean, it will reject. We probably had 30 or 40 rejects this year for people who did not bring in their 1095A. And yeah, they got to go get it. They got to call the insurance company. They got to log on, et cetera, et cetera. We try and get in front of people with this stuff, but it's difficult sometimes. All right, so that's it for. Oh no, sorry, I got one more. I know there was one more. Module 8. There we go. Marching along here. Okay, this is the tax benefits for education, basically the American Opportunity Credit. Um, and the lifetime learning credits. Those are the two that again are going to be these are going to be non-refundable credits. Well, the lifetime learning is non-refundable. American Opportunity is two parts, both non-refundable and refundable. The two ways again that education expenses can impact the tax return. Again, if your student, if your dependent gets a substantial scholarship, grant slash fellowship in excess of expenses, that is reported on the student's return as income. And it can be a bit of a surprise to people, but my view is always, if you're paying tax on $10,000 in excess scholarship income for a student, that's probably going to be maybe 10%, that's $1,000. That's a whole lot better than borrowing, that much more in student loans to fund your education. Again, all of these are based on a variety of characteristics of what the student is doing, where they're going to school, whether they're full or part-time, whether they're in graduate school, and we'll get into that. So again, things that you really need are the 1098T and any kind of account statement from the school or any notes that they may have. Usually the 1098T is where we go. Again, you get it from the bursar's office. Every student has an account. They can pull that down very easily. So again, eligible institution is any accredited public, nonprofit, or private college, university, vocational school. Okay, beauty schools are, and welding schools are just as qualify as Princeton does. Um, Eligible student, An eligible student is the taxpayer, the spouse, or dependent who is enrolled in one or more courses that meet the criteria of the American Opportunity Credit and the Lifetime Learning Credit. Again, everything that's covered has to do with qualified education expenses. That's tuition, fees that are required for enrollment, any course materials, books, lab fees, art supplies, things like that. Um, Again, the one thing at the bottom that you want to be careful of, one thing that does not include is room and board, sporting events, health insurance, transportation, parking fees, and all of that is not a valid education expense. Um, Again, the a scholarship, grant, or fellowship is tax-free only to the extent that it doesn't exceed the qualified education expenses. Again, in certain situations, again, if they're in graduate school and there's research involved, generally they're going to get a W-2. Hopefully they'll have tax taken out. But in general, the types of students that we see are pretty much in line where their expenses are generally greater than their scholarships. So this is what the 1098T looks like. They'll have the school name here, their EIN. Box one is the payments received for qualified tuition and related expenses, and box five is the scholarships or grants. So basic eligibility, again, to claim the credit, the following must be true. They cannot be claimed as a dependent on somebody else's tax return. The student must be the taxpayer, spouse, or dependent of a filer. Dependent cannot file for the education credit. So an 18 or 19-year-old can't file their own tax return and claim the American Opportunity Credit. There are instances, so like whether the student is emancipated and all that nonsense, but for 98% of the cases, it's mom and dad are going to claim the kid and the credit. They can't be filing, again, the parents can't be filing separately. Again, there are AGI limits, but they're very high. Who can claim the education credit? Taxpayers who paid the qualified education expenses for higher education are eligible, and attend an eligible institution can claim the credit. Again, qualified education expenses paid by a dependent or by a third party for that dependent are considered paid by the taxpayer who can claim that student as a dependent. That would be, for instance, the whatever the institution that they got the student loans from. So the money went, the bank sent it. Well, it's really I that sent it. Whoever, where that money came from. In reality, I'm on the hook for it one way or the other. So the American Opportunity Credit. Okay, this is the most powerful one, if you will. They must change, attend an eligible institution. It covers tuition fees, book supplies. 40% is refundable. So again, the maximum credit per eligible student is based on $4,000 of qualifying expenses. Okay. Um, in other words, if their expenses were 10,000 and their scholarships were 2,000, they're out $8,000, but only $4,000 of that really qualifies for the calculation. You can only be claimed for 4 years, so 4 years as an undergraduate. They must be enrolled at least half-time. Um, no felony drug conviction. They can't file merit separate. And again, it's only available if they had not completed the first 4 years of post-secondary education before the tax year. So what you have to remember is generally the a school year goes over 2 calendar years. But for purposes of how this is calculated, generally, if someone graduates high school in May or June, they go start college in September. They're going to be paying for the spring semester by December. So that's where all those expenses get lumped in. So basically, when they're a senior, the year that they graduate, you're not going to be able to claim it that year. It's kind of like a weird way of thinking of it, but it all kind of makes sense. You only get to claim it 4 times. And actually, the IRS is very big on this. In my paid practice, we had this come up 1 or 2 times where somebody, uh, again, you can send it in. They don't do the check on the way in, but you will get a letter saying explain. Again, the student um, under age 24. None of the credit is refundable if the taxpayer claimed the credit is under 18 or age 18 and a half a year and has earned income that was less than one half his own support. Again, none of this stuff really ever hits our table. This is all pretty straightforward stuff that we see. Now, the lifetime learning credit, again, this is for people who, again, you've already graduated. These are it's a non-refundable. It does cover some undergraduate classes, graduate courses to improve a job skill. You've got your degree, you decide you want to learn how to be a welder. You go to Votech school and you can do some of that. The maximum credit is $2,000 per tax return on $10,000 of qualified expenses. So 20% of the eligible expenses until that limit is reached. Again, must be an eligible institution. Um, Tuition and fees, the same side of rules apply. Um, Again, per return, expenses from multiple students can be combined to increase qualified expenses towards the overall 10,000 maximum. And they can be less than half-time students. So again, night school, weekends, that's where that'll work to its advantage. Again, there's not really a decision process here. The situation we see a lot of times is some students in our cohort, they start at like Mercer County College, for instance, which is very inexpensive. And depending on their income, they might be going for free or very low costs. So they're not going to get, if they go do the whole 2 years there and then transfer to Rutgers, or even if they stay at Mercer and complete their 4 years there, which they can through a number of universities in West Windsor, they're not going to get the full effective, if you will, for the American Opportunity Credit. But on the other hand, they're not spending nearly as much either. So, okay, in the 4012, there's a chart like this which will show the differences between the two. So eligible expenses. Okay, this is like what you'll see pretty much is payments was 9,900. There were scholarships of 5,360. The difference is $4,540. So they're going to claim $4,000 and get the max credit provided that their income is within limits. Now here it's flipped the other way, where tuition was only $5,000, yet they got grants of $9,950. Now the grant income is going to be $4,950 that they're going to have to pay tax on. The student's going to have to. And depending, excuse me, on any other income, we may have to pay the kiddie tax, which is based off what mom and dad's tax rate is. This is where it gets a little complicated, and we generally try to avoid these because unless we're doing mom and dad's return, then we get a chance to see it all and we can kind of do our best work that way. Um, Again, the choice is clear for most. In this case here, again, you're going to get the full $4,000 effect of the return, and yeah, that's what you want. Again, if box 5 and box 1 are the same, there's no need to even input it because they're not going to get any of the credits. And if for some reason, let's say box 5 is just a little bit higher than box 1, that's when you need to kind of like figure out with the client. It's like, well, was there other expenses other than what the university paid for? Did he buy a laptop? He's an art student. Did he buy a camera, et cetera, to try and mitigate that difference? Um, Again, we've had several Princeton students come in, or even actually Rider as well. They had generous scholarships in excess of tuition, and they're going to have to declare that as income. Schools will not give any kind of tax advice. It's very clear about that. Even Princeton, it'll basically say, consult your tax advisor because we're not going to tell you what to do. So when the student is dependent, okay, and he almost always is, whenever possible, the best option is the parents and the student coming together to get their tax returns prepared. Again, the credit, if any, is claimed by the taxpayer who claims the dependent. Again, if any grant income is reported on the student's tax return, is not income of the person who claims the dependent. And again, in that situation, if it's only $3,000 or $4,000, and he didn't work a summertime job or whatever, it's going to be very little, maybe zero of tax owed. Okay, yeah. In some cases, Yeah, that's pretty much that kind of a recap as well. I didn't want to get too much. So now that is that. And what I'd like to do, I want to try and do something here and show everybody. Actually, let's do a return, um, because yeah, we got a little bit of time here. I'm going to try and see if I can do this. But first, I'm going to stop the meeting. I'm going to stop the share for a second. I'm going to see if I can. I'm going to send everybody a file here. Never done this before, so let's just see how this works. This is an actual tax return we're going to put up on the, there we go. So that's a tax return with a the intake form. And I got to go back to sharing. And so here we have, if you can open it, fine. If not, you can just watch mine. This would be like a typical form here. This is Judy Jetson. Um, she was born January 1st, 2002. She works in a warehouse. She lives here in Trenton. I've got her phone number. I've got her email address. Um, I would ask her to, oh, did you really work in two or more states? Oh, no, I didn't. That's a mistake. So again, this is all part of the intake. She indicated she's a U.S. citizen. She wants direct deposit, and she's never been married. Okay, so there's no kids involved. Great. So now we go on to page 2, which has, she's indicated what her kind of wages are. So she checked off wages. She didn't say how many. She said she got some unemployment. Okay, that's great. So we're going to go down with anything else here on page 3. Oh, she had some student loan interest and nothing else. So let's remember on the tax preparer, she sat down. Oh, and I got the free text here on the page 4. So what happened is in this case, the greeter went through all this with her, and she indicated that she had unemployment. So she got her phone out, got the 1098 from Department of Labor, and the greeter and her wrote down that she got $3,500 in unemployment compensation with a tax of $350. Um, she had made note that her student loan balance payment was $300. She's got rent of $750 a month, and she's paying yeah, 9,000 a year. Here's her routing and account number. Okay, so what I'm going to do now is I'm going to jump into TaxWise and show you how to do one, because that's just the fun stuff. Now, when I get you all logins, and we'll talk about that when I'm done here, the um, the way to kind of play around with this, doing dummy returns, is to um, use the first 5 digits of your own social. Oops. And then the last four could be a dummy numbers, because we'll all be sharing the same site ID, so there can't be duplicate socials. So this is the best way to kind of get around that. Okay, so I've got Judy in here. There's a bunch of information that I'm gonna just kind of go through here. And let me just get this here. There we go. Okay. Okay. How's everybody doing out there? Okay. I'm not boring anybody. Okay. So now we keep going down the main screen and answer all these questions that are there. So her address didn't change. She didn't have insurance through the marketplace, and she didn't deal in Bitcoin. Okay. She said she was single, going all the way down here. There's no dependents. And she is a New Jersey resident, so we're going to stick with New Jersey. And here's the first spot where we start putting in the bank info. Very important that we get this right. So, Bank of America. There we go. And then at the bottom, there'll be a place, so a lot of information that you won't have to put in, but you do have to put in a PIN number for us and today's date, and that we authorize United Way, which is our organization, to send it. We don't need to put in the driver's license information, and all the other information at the bottom here, this like prepare information, will be hard coded by me. So you don't have to worry about it. Notice how here on the main info now I got a green check mark. So as far as I'm concerned, everything is ready to go. So I'm looking at all the stuff I got Judy stuff in. Now I'm going to go. I know she has one piece of income with a form. That's the W-2. I'm going to go down here to the W-2. I'm going to click on this. And I also noticed that her box one, it's the same address on here. Her box one number, wages, is different than Social Security and Medicare. So I'm going to click on this thing here, take the calculations off, and 15 is also different for the state. So I'm gonna have to manually type that in too. So I'm gonna type it in right here. She worked at Amazon, get a lot of Amazon people. And that should, there it goes, that all flows. So I'm just gonna free type in all of this stuff. Okay. Now, she's got something for that and family leave insurance. Okay, she's got a code C here, which is for 19. I think she made a little contribution here and there, a D. Now you don't need to put all these in. We'll kind of go through that at a later time. And now we got New Jersey, state wages. 172 is okay. So see how the W-2 now turned green? So I've got all the information that I need there. Now, going back to her information, it said that she had some uh, unemployment. So right here is a 1099-G for New Jersey unemployment. Total benefits received were 3,500, and federal tax withheld is 350. Okay, student loan interest. Okay, it said she had some student loan interest. And we go up here to, I believe that's worksheet 2. Okay, student loan interest amount paid can't be more than 2,500. She paid 300. There we go. So now I'm trying to get through all of the numbers here. Okay, I've got the unemployment, I've got the rent, I've got the student loan. Now for the state of New Jersey, what we're going to do here is we go down to page 3. And right here it says rent you paid in 2024. So in this case, it's going to be $9,000. That's 750 a month. Okay. Notice how she got a little bit. I'm going to take that out again. Notice how that increased her New Jersey refund by about 50 bucks, which is kind of the standard number. Now there's a whole lot of other red here that we need to address, and that's what, now that I'm done, okay, I've got the bank account information, I've got the rent, I've got all this other stuff. So now I'm going to kind of clean some things up here. When you see a red exclamation point, that's not really an error, that's just drawing your attention to it, that maybe you want to make sure you have that right. But in the case of our New Jersey return, I know there is some issues here. You need the school municipal code, which the city of Trenton is 4 ones. And then on K, she was her main income in the US, yes. And did she have health care? Okay. If she did not have health care, there is still a penalty, unfortunately, in the state of New Jersey, which you really can't get around. We'll discuss that at another time too when we talk about New Jersey in more detail. But for the time being, I'm going to say that she did. Now, here's the 8880 for the uh, credit for retirement savings. Was she a full-time student? No. So that should get rid of that, I think. Oh yeah, was there any other distributions? And she didn't have anything. So based on with the credit that she got, okay, looks like she's ready to go. She's going to get a refund of $87 and 156 from New Jersey. And that's kind of in a nutshell, kind of how this thing works. I'd like to spend just a few minutes as we wrap it up for tonight to show you what happens when Judy suddenly becomes a single parent, okay? And we change her whole situation. So now it turns out she's not single. She's got one child. So right away, my refund's going up. Okay, because I know there's going to be at least one dependent in there. So this is Elroy. Elroy Jetson was also on 2-0. Let's make this 2-3. No, yeah, let's make it two. Make it a little older than that. There you go. Okay. Okay, was in the home for 12 months. Code one, child live with you. See how it already the software already added the child tax credit. So he met the relationship test. He's in the age bracket, um, and lived with her for 12 months. Now, there's one thing here that you got to be really careful of. This is the one kind of huge hole for tax wise. Take a look at what it says for federal refund right now for Judy at 2230. When I click on this box here for EIC, see how that just exploded? Um, and that's key that you get that. In almost all instances, um, when the primary has a social and the children have a social, I always click on EIC. If for some reason their income is too high or too low, there wasn't enough, it's no harm, no foul. So again, in this situation, look at how dramatic that return went. And these are the kind of things we like to see. So here is the EIC worksheet, okay, that basically um, our due diligence to make sure that she gets all that extra money. So it's going to ask us a series of questions. And what it's really doing is it's just asking you to affirm the situation that as it exists. For instance, 1A, if the taxpayer's filing status is head of household, were they married at the end of 2024? The answer is no. Does the taxpayer have a social security number that allows her to work is valid for EIC purposes? Yes. Was the taxpayer a non-resident alien for any part of the year? That never comes up, so no. Could the taxpayer be a qualifying child of another person? I don't see how that's possible. Okay, that's no as well. Now we're coming into the specifics of the child. Is either the following true? The child is unmarried or the child is married and can be claimed as a taxpayer's parent. Is the child unmarried? Of course, because the child's 4. Did the child live with the taxpayer for over half a year? Yes. Do you know of any other person who can claim the child for EIC purposes? No. That doesn't mean that it doesn't happen, but from where we're sitting while we're doing her return, that's how that works. Does the qualifying child have a social security number that allows him or her to work or valid for EIC purposes? Well, yes, because Judy showed me the social security card. If you took EIC in the previous year, was the reducer disallowed? We always answer no because we really don't know. And see how everything is red now on that. Also on the 8812, these are the due diligence for the qualifying child. What I kind of point out is notice how in order for us to affirm her for the earned income credit, we basically have to acknowledge everything along the right-hand side. Notice how there's like yes and there's a mixture of yes or no answers, but they're all down that right-hand side. And that's pretty much what you have to do to make sure that this happens. I mean, you got to go through it and read the questions. Sometimes people put like, they click a yes when it should be a no because sometimes it's worded funky that way. For instance, especially here. Um, in some of these they're a little funky, particularly if they're older, as we're talking about a qualifying relative, not a qualifying child. So in the 8812, again, this is another one. If you claimed it, was it disallowed? No. So again, that's that situation. So this is one of again, I kind of went through this really quickly, but it just goes to show how just one additional layer of information or something about a person's background can change the return dramatically. And these are the kind of things like if we did, if you had gone through Judy's return and you claimed her as head of household, you put all that information in, and you told her that your refund is $2,200. So, well, last year I got close to 6 grand. How can that be? You're like, oh, I forgot this. And you click on that, and now you're back to where you were. And so that's a really good help to make sure that we've gotten everything. So I just want to kind of like tidy up with it. Now I'm going to stop this again. I'm going to stop the recording.